Hi everyone, welcome back. So we were discussing about the Sharpe ratio. So Sharpe ratio is actually how much excess return you earned per unit of total risk. And the formula for Sharpe ratio is risk of portfolio minus risk-free rate divided by the standard deviation of the portfolio. So Sharpe ratio is actually about the whole portfolio. It's not about for a selective stock. And the purpose is to compare the performance of the portfolios, and it's used in CML, capital market line. Okay, so uh, here, if you look at the diagram here, so here it's about standard deviation, which is the total risk. They are talking about the total risk when we are talking about the Sharpe ratio, and on the y-axis, it's again the returns. In every diagram, in all of these diagrams, we have when we saw the charts or the graphical representation, the y-axis is always the return, and the x-axis is always the standard deviation, or the it's always related with the beta. So whether it's systematic or unsystematic or total risk, x-axis represents the risk, whether it's systematic, unsystematic, or total. So there is, as of now, we have no measure to calculate the unsystematic risk. We have not discussed about the unsystematic risk, any measure to calculate. We have discussed about total and the systematic risk. Okay, so let's discuss about the Treynor and the Jensen alpha ones. Then we will get back uh, with our capital asset pricing model. Treynor ratio is about the systematic risk based version of Sharpe ratio. Like I just, we have not discussed about anything about unsystematic, but we are only discussing about systematic risk. Uh, Beta is also about systematic risk. Uh, Here it's beta. Here it's total risk. When we talk about alpha, alpha is again based on beta. Uh, when we talk about Sharpe ratio is also again on total risk. When we talk about tenor, it's again about systematic risk, but not about unsystematic risk. And the Turner's ratio, it's like Sharpe ratio, but it uses beta instead of standard deviation because it's about systematic risk, not about total. So total risk, if it's about total, systematic plus unsystematic. So when they are representing total risk, uh, they talk about standard deviation of the whole portfolio. But here it's not about total risk; it's about only the systematic risk. So turnover ratio, it's about the return from the portfolio. We subtract the risk-free rate and given the factor beta of the portfolio. The comparison here, there is a table for comparison. So Sharpe ratio is the systematic risk. The Sharpe ratio is about the total risk, standard deviation, if you can see here. Turner's ratio is about the systematic risk part only. Jensen alpha, we will discuss about it in a moment. And these information ratio, this is not actually relevant to us as of now. We will discuss about it in detail when we will talk about uh, a portfolio. So we are not discussing, let's just eliminate this thing as of now. So it measures the per unit of systematic risk, not total risk. Understand this thing. So whenever we are talking about beta, Any measure where beta is involved, any measure where beta is involved, we are only talking about from a perspective of systematic risk. Just remember this thing. When we are talking, when we are using standard deviation, we are talking about total risk. I hope you will not forget this. We will use this, and every time I mean, when we are talking about the advanced level of valuation, or when we are doing a real-time valuation, it's very difficult to again brush up on the facts to tell you about the basic stuff. So it will be difficult at that time. So that's why I just wanted to make it a detailed presentation here. So just remember these things. Beta means systematic risk. Total risk is represented by standard deviation. Standard deviation. So here it's on. We are talking about a portfolio because there are multiple securities and there should be multiple securities, and we are talking from a perspective of a portfolio. You cannot make a portfolio and talk about systematic and unsystematic risk or total risk. So either you are talking about market versus a single stock, or you are talking about market versus multiple stocks. When you're talking about multiple stocks, then it's a portfolio. When you're talking about simple stocks, single stock, then it's relatively easy, and it makes more sense to use uh, beta or systematic risk, because unsystematic risk is with the stock, and the systematic risk is with the market. Okay, so we have discussed about uh, Treynor ratio also, which is a systematic risk-based version of Sharpe ratio. Sharpe ratio, how much risk, unit of risk for per unit of return. This is unit of, how much beta per unit of return again. And now let's talk about Jensen's alpha, which is the last topic, last measure of portfolio, which we will be discussing as of now. So it's a performance driven, uh, a performance driven metric, which is derived from capital asset pricing model again. So Jensen's alpha is nothing but the return of the portfolio, and we subtract capital asset pricing model out of it. Alpha, uh, return of the portfolio, we subtract risk-free rate plus beta, RM minus RF. And I think Jensen's alpha is similar to alpha. We had discussed about alpha previously also. So Jensen's alpha is similar to alpha only. But here, when we talk about alpha, we are talking about the formula here. So it determines whether a portfolio beats the capital asset pricing model, CAPM, or not. And if the alpha is above zero, it means we have outperformed. If the alpha is less than zero or negative, it means we have underperformed. And let's quickly do a final comparison of all these securities, all these measures which you have discussed. So capital asset pricing model is a type of model, and model means in itself it's hypothetical in nature, or it's scenario based, or there are assumptions involved. It tells you is it tells you the required rate of return based on market risk. In securities market line, it's a graph. It tells you whether or not an asset is undervalued or overvalued. Capital market line is again a graph. Capital market line is the best risk return portfolio. Which one would be your best risk and return portfolio? So you will be able to work on multiple securities and based on their risk. So the optimal portfolio, CML, it only applies to efficient portfolios, not individual securities. We discussed about this point here. So that's why it's we want to create a portfolio given X number of securities and we choose from those more securities. So, okay. So since we are talking about it, understand this thing. Okay, when we are talking about mutual funds, so there are regulations involved from MFI. There are regulations when we are talking about stocks. There are regulations involved when we're talking from about stocks from a bank's perspective, from a pension fund's perspective, another from any perspective. So there are regulations involved that you cannot purchase high risky securities, because high risk securities you cannot purchase because see, this makes sense if you are in if you are investing in your pension fund every month. So by the time you are 60, you will be needing that money. And if I am saying that I am you will be needing more money. So at this time, your risk appetite is high, and these are the regulations or the rules which a portfolio manager actually has to follow. So efficient portfolio means given the level of risk, the time frame, and other factors, what are the after screening everything, what are the best fit of stocks which could be used to make a portfolio. So if I am saying that the time frame is, I mean, if you are 20 years old, you have 40 years of lifetime, like 20, 40 years. So this money you can keep aside. So as of now, we can use high risk portfolio, high risk securities to make a portfolio out for you. But if you are in your 50s and you are doing a fixed deposit for with the bank and you need your money in 5 years, so we cannot invest in risky, high risk stocks, because within 5 years, so the bank or any institution is not going to give you multiple, a very high return, because liquidity, maturity, uh, inflation, these are the factors which are actually going to influence your rate of return. So using by keeping, okay, we will discuss about this everything in detail when we will talk about portfolio creation, the steps in portfolio creation. But there are a lot of factors which influence the screening, which influence the selection of stocks, picking of stocks. And from those pick, you actually have to look into the risk and the return and make a efficient portfolio for yourself. So this is what we were talking about, the CML, capital market line, the best risk return portfolios. Beta is a metric, again, it's a metric for systematic risk. CML, okay, we have discussed about it. Beta is a metric for systematic risk. It tells you about market sensitivity relative to the stock of your choice. Alpha is again a metric, skills and excess performance of portfolio managers. Sharpe ratio is a metric of total risk, which Return on the portfolio, return on risk-free upon standard deviation of the portfolio. And Treynor ratio is again a um, systematic risk-based version of Sharpe ratio, which is risk from portfolio, risk-free rate upon beta of the portfolio. So don't forget these things. Sharpe ratio, Treynor ratio. For 1 unit of risk, how much return am I generating? For 2 units of risk, how much return am I generating? For 3 units of risk, how much return am I generating? For 1 unit of systematic risk, how much return am I generating? For 2 units of systematic risk, beta is systematic. Pardon my handwriting again. Beta is systematic risk, and the standard deviation is total risk. Okay, we are done with this thing. We are done with this topic, the other measures for portfolio creation and return measures. And we have not discussed these measures in detail, but an overview. Uh, See, but for the Sharpe ratio, when we talk about Sharpe ratio, let me just clean it up a little bit. When we talk about Sharpe ratio, when we talk about Treynor ratio, and when we talk about alpha, so these are actually performance measures. So that's why they are metrics. So these are actually performance measures. And okay, let's do one by one more time. So capital asset pricing model is actually, it gives us the required return. SML visualizes whether the asset is mispriced or overpriced. Capital market line shows the best possible risk return trade-offs. Beta tells us the level of systematic risk. Sharpe ratio and Treynor measures the performance, and alpha tells us if we have outperformed our expectations or not. And together they all form the backbone of modern portfolio theory. So these all are actually a part of modern portfolio theory. And since we are talking about portfolio theory, I will make a note of how to create a portfolio and all the pointers which we need to keep in mind when when we are making a portfolio. And I will make a video in future for this. And to summarize everything, beta actually measures the sensitivity of the market movement. Capital converts beta into required return. Uh, just remember this thing. And let's go back to our capital asset pricing model. Now since we have talked about everything, so let's do the Q&A section. Let's move to the Q&A section. Okay, so when we talk about capital asset pricing model and when we do question and answers, these are theoretical questions only. So doing questions actually test your concepts, and it's very important. So let's quickly just try to solve the questions. So question number one is, so these are actually first 10 questions are actually easy to hard questions, but so these questions are arranged easy to hard, and the questions below that are actually the hard challenging questions, and we will discuss about those hard challenging questions later on. So let's first do the easy to hard questions. So what does CAPM primarily relates to? Uh, does it relates to risk of accounting profit? Does it relates to expected return to systematic risk? Does it relates to asset price to book value? Does it relate to company size to return? And risk to accounting profit, no. Asset price to book value, no. Company size to return, no, not really. But yes, expected return to systematic risk. Why? Because the formula for capital asset pricing model is expected return is equals to a risk-free rate. We add the beta, we multiply it with the beta, RM minus RF, market return, the risk-free rate, and this one is known as the market premium also. So it links expected return to systematic risk. Uh, systematic risk, which is involved with the systematic risk, is actually involved with the market, and it actually is measured by beta. In capital asset pricing model, RF represents, yes, very easy question. It represents the risk-free rate, not dividend yield, not beta. RF in itself represents the risk-free rate and not even market return. Market return is represented by RM. Beta in itself is a signal sign. It's beta. The sign it's identifiable using the sign, or you can identify the sign. And dividend yield, we did not talked about anything about dividend yield. Okay, so question number three: if a stock has a beta of one, so beta of one, we talked about beta greater than 1, we talked about beta equal to 1, we talked about beta less than 1. So this means it's negatively related, this means it's perfectly related, and this means this is strongly related. So when beta is equal to 1, this means that it moves with the market on an average. We cannot infer anything that if the stock market goes up by 10%, our stock should also go by 10%. No, but yes, it would be strongly related, not as much as more than 1%, but yes, perfectly in somehow we expect it's related to market. So the answer for question number three is it moves with the market on an average. Okay, so question number four is about the market risk premium and what is it defined as. So market risk premium is extra return the market offers above the risk-free rate. So extra return, if we talk about the expected return expected, not ERRE, expected return is equals to risk-free rate plus B, RM minus RF. This is the market risk premium and how much market offers above the risk-free rate. Not RF minus RM, not beta into RF, RM minus RF, which is the option number C. Okay. Question number five, risk-free rate is 4%, RM is 10%, beta is 1.5%, and we subtract the risk-free rate again 4%. 4 plus 1.5, we multiply it by 6. 4 plus 9 is equals to 13%. So the answer for question number 5 is 13%. Question number 6 is a stock with a beta of 0 means a stock with a beta of 0 means that the stock has no systematic risk actually. The stock has 0 beta. This means the stock doesn't have any systematic risk. This means RF plus beta RM minus RF, this part is going to be 0. So if the stock doesn't have any systematic risk, no systematic risk, this means it's a government T-bill. The stock does not move with the market. Either it's risk-free or uncorrelated, but but you still may have total risk. Okay, so let's talk about question number 7 now. Question number 7 is which risk cannot be diversified away? And yes, we talked about it. The risk which cannot be diversified away is systematic risk. So because systematic risk is involved with the economy or the broader picture. Unsystematic risk is involved with the company, which is also the firm specific risk. Unsystematic risk is this, these are so total risk is systematic plus unsystematic. Systematic risk. Okay. Question number 9. Question number 8 is about capital asset pricing model, and analysts forecasted return to be 9%, and capital asset is expecting 12%. So we expect 12%. If we want to buy a stock XYZ, so we want to generate 12% return. Those the analyst forecast the return of 9%. So this means that the stock is actually overpriced. Understand this thing from the alpha perspective. We are saying the return is 9%, and we are saying the capital asset pricing model return is 12%. So this means the stock is overpriced by 3%. Or let's assume that you have $100. So the expected return from this stock is 12%. Given the risk, the capital asset, uh, the capital asset pricing model risk, given the return, expected return using capital asset pricing model is 12%, but the return the analyst is forecasting to be 9% only. So this means it's overpriced or overvalued, whatsoever you want to call it, overpriced or overvalued by 3%. And question number 9 is about which must increase required return under capital CAPM. So which of the following must increase a stock's required return under capital asset pricing model? So required return is actually influenced by higher beta, because if you look at the formula, the risk-free rate plus beta RM minus RF. So RF is going to be constant in both the cases, because beta is a multiplier here. Lower beta means lower multiplier and higher beta means higher multiplier. So higher beta, okay, let's consider other factors also. So low risk-free rate doesn't have that much impact. Understand this thing, because uh, it's we are just adding it up and subtracting it again. So it doesn't have that much impact. Low market premium, not really, not really. But higher beta would have the maximum impact because it's a multiplying factor. Look at the formula here. So expected return, if you look at the formula, so beta actually is a multiplying factor. And beta is actually has the power to influence the whole return. And higher returns, higher required return means higher risk also. So higher beta not B, but beta. Higher beta means higher risk also. Systematic risk. Take risk. And the last question of this, last question of these 10 questions, easy to hard. Suppose the risk-free rate is 2% and the market premium is, okay, understand this thing. Our market premium means RM minus RF. Don't make a mistake of plugging, don't make a mistake of understanding this as RM. So market risk premium is 2%. The risk-free rate is 2%. And first, first case is that the beta is 0.8% and the market premium is 6%. And the second case is beta is 1.4% and the market premium is 6%. So 6.8, this is going to be 10.4%. So what do you make out of this? So which statement is correct? So previously we just discussed about it, this kind of situation. So higher the beta, higher should be the return. So this means that beta B requires higher return. Yes, exactly. The answer is B. Stock A require higher return? No, the require higher return will be required by B because the beta is high. So this is the importance of beta, the systematic risk. Always make a habit of connecting systematic risk or understanding systematic risk. Whenever we talk about beta, we are discussing about systematic risk, and systematic risk is the broader picture, which is related to economy and the broader picture. Okay, so let's quickly do question number 1 to 10 of the hard challenging questions. Uh, Okay, so let's start with the hard challenging questions. So question number one is about a stock has an expected return of 14% based on the analyst forecast. Capital asset pricing model is capital asset CAPM expected return is 11%. This means if you look at the from the perspective of alpha, so we are expecting 14% and we are saying the capital asset pricing model is 11%. This means the stock is undervalued by 3%. So what should you conclude? That the stock is undervalued, not overvalued, but undervalued. And why is that? Because capital asset pricing model says the required return for the stock is 11% and let's expect 14%. So actual is greater than required. So this means that the stock is undervalued. When we talk about portfolio beta, so portfolio beta composed of two stocks. A portfolio is composed of two stocks. A has 40% in A, 60% in B. A's stock A return is 7%, beta is 7%, and B's is okay. So what is the portfolio's beta? So it will be dependent on the weights. So 40% of 0.7 plus 60% of 1.5, this will be equal to 0.28 and 0.90. So this will be equal to 1.18. So this will be the portfolio beta, the beta of the portfolio. This will be the beta of the portfolio. So this was a good question, and this is actually among the hard, challenging questions. So this was actually a absolutely fantastic question, which you should know when calculating the portfolio beta. A stock has a beta of 1.3, market premium is 5, risk premium is 3. Market premium, risk-free rate. So risk-free rate is 3%, the market premium is 5%, and the beta is 1.3%. 1.3, not percent. So 3 plus 6.5, it's 9.5%. So, but the new information says increase the beta estimate to 1.7%. What are the changes that are required? So 3 plus 1.7 into 5%. So this will give us 11.5%. So here, because the beta is increased, our required rate of return is also increased by 2%. I hope this was clear. A stock has a current return of 9%. So actual is 9%. Actual is 9%. Expected is 12%. So here the actual return is 9. The actual is less than expected. So this is overpriced. As of now, I I believe, I hope that you have understood the concept, what we have discussed. And this is the third lecture. This is the third episode of the same series, part 3. Which of the following should not increase the capital asset pricing model expected return? So which of the following should not increase? Beta does increases the capital assets expected return. Increase in market risk premium will increase. Risk-free rate will increase. So company specific risk, this is the answer because company specific risk is unsystematic. This is unsystematic. And beta, when we talk about capital asset pricing model, it's only about systematic risk. Okay, so let's quickly understand question number 6. Market risk premium is 12, risk-free rate is this. Stock beta is 9, offering 13.5. Is the stock correctly priced? And when we calculate the return, the expected return of this stock, it's 11.2, and the actual return which is being offered is 13.5. So this means that the stock is actually underpriced. And I hope you have understood why I have taken our respect expected return. I have calculated it using all the I have plugged in all the numbers. Question number 7 is about if a stock has a beta of 1, so what do you make out of it? If the market variance doubles, which is true under capital asset pricing model, market variance means required return to stay the same. So capital asset pricing model actually uses beta. And if the market variances change, beta would change only if the covariance does not does not change proportionally. But when you are not told how covariance change, but what you're supposed to do, the capital asset pricing model actually requires returns depending on the beta, not directly on the market variance. And in most standard users, you do not assume required rate of return changes unless beta changes itself. So I am going to assume that the required rate of return stays the same. Beta depends on covariance, not on market variance alone. I am saying the market variance doubles, but my relationship of the stock is 1 so the required rate of return should stay the same. Question number 8, 9, and 10. What I will do is I will put these questions in the description, or I will create a poll out of these questions. And let's conclude today's session here only. And thank you for attending the session. I hope you have learned something of value. Thank you. My name is Deepak Bish, and I will see you in the next video.